following is a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Well, I was a prodigy when I got in this business at about 16 years old.
Financial
you were already
prodigy.
about 40.
Well, you were reading the Wall Street Journal at 3, weren't you, or something?
Welcome to the show. I'm Victor McClure, your host, and my co-host, Guy Allard.
Happy Saturday to all.
And I was not a child prodigy, but my father did make me read the Wall Street Journal every day from like 10 years old. I thought nowadays they'd call you in for child abuse. He'd have been arrested in a minute, because that obviously has to be child abuse, but it apparently worked out.
You were reading the Wall Street Journal. My mom was punishing me, making me handwrite out the 119th Psalm, which is the longest book in the Bible by about a bunch. It took me weeks.
Oh, my dad was in the commodity business. He's a commodity broker. Back then you called a stockbroker or commodity broker. Everybody's brokers. Now everybody's advisors.
That's right.
Mostly the same thing, but everybody's a broker. And remember the movie Wall Street? You wanted to be a stockbroker, or commodity broker or whatever. But he used to tell me, he used to give me I was like 13 or 14. He goes, I've wrote out this pitch to sell crude oil options. Read this. It looked like, I'm reading Chinese.
Right.
And I'm like, well, you didn't say that very well. Repeat it to me. He said, oh, that sounds terrible. You can't give away bread in a famine. I was like, okay.
Hey, I was on the website today. I love myretirement.com.
Yeah.
And I saw a picture of you and your dad. Is that a recent addition?
I think there's might be two of them on there.
There is.
My dad and my mom are
It
on
looked
there
good.
too.
I just don't remember seeing it before.
Yeah, no, I actually my sister found that picture. I hadn't seen him in a long time. The reason why we're talking about my parents or whatever, my dad got me in this business. I was a nuclear chemist in the military for 6 years, and he was mad about that because he wanted me to work for him out of college. I didn't want to. I didn't want to take any money from my parents, period. No, that was just me. I was very independent. So I started in that business, and I found out commodities were not for me. In the 80s, commodities are kind of like day trading on steroids. The commodity market moves. It doesn't move any more percentage-wise than the stock market, typically less, but your leverage is so much more.
Well, no, wait a second. I got to get the chronological order of this. Your dad brought you into the commodity business.
Yes.
Which was not for you.
In the 80s. That's
and then you brought me into the commodity business in 1995. After you already knew it wasn't for you?
Now that was
what am I missing here?
Because I was doing mostly stocks then.
Oh, that's right.
But we both still have Series 3 licenses.
We had a real good, and let me clarify that. I was just giving Victor a hard time. We had I guess, the number one managed commodity program in the country, at least. And he was ranked in the top 10 in the world, and it did great for a long time. And it was for high net worth individuals. We weren't putting retirees in it. And you hear us talking all the time about managed programs, and they may be really good, but something usually happens that stops them. And that happened to this, too.
That thing beat the S&P like 25 years in a row. At time, it's number one or number two manager in the world.
He was a mathematical.
That's why it's hard chasing things. Now, I'm much more of a conservative personality. I don't gamble. I don't like gambling. I'm conservative pretty much to the core.
Yeah, you've lost a couple lunch bets to me, just saying.
And so, to me, actual planning for someone's retirement is actually a benefit to society. If you're helping people bet on stuff, whether it's an oil well or commodities or whatever, you're benefiting yourself mostly.
You may be able to increase your odds some, but no one's got it figured out.
Right. And remember, if somebody's trying to tell you this next oil well or real estate deal is the greatest thing in the world, why are they letting you into it? They keep it for themselves, trust me. There's never been a deal that came around that was such a greatest real estate deal in the world. And they said, normally I don't let people in. But for this one time, because you're such a good person, or I knew you from high school, I'm going to let you in. Just one deal. And maybe if you become a good partner, we'll let into a future.
That's right. And we talked about this a lot last week, but that's why you want someone that has experience, someone that's been through that and learned and seen the market up and see the market down and see inflation when it's at its best. I mean, they've been through it. It's one thing, and there's nothing wrong with book knowledge. You have to have it. But it's completely different to live through these things.
Also, think about it. If you have a person that says the stock market's terrible, they only buy real estate or whatever, they only do gold, whatever it is, their experience is in that one thing, right?
Yep.
So it's going to be real difficult to get an unbiased opinion from somebody that only believes in one thing.
They got blinders on, don't they?
We have, like I said, we are licensed commodity people, stocks, bonds, CDs, anything you could want out there, plus annuities, life insurance. And I own rental properties. I've owned real estate for decades, so I understand what they do, and I've been involved in and understand real estate deals and dealings, and so that is closest you're going to get to more unbiased type of opinion. You can't find somebody that's one thing. In other words, go to the Chevy guy and say, "What do you think about this Nissan?" I don't care if they're the greatest guy in the world. They're going to skew you towards the Chevy. They have to.
Well, and I tell you, with the radio show and the ads and the publicity that Victor and I get and McClure Capital gets, we get a lot of phone calls. And, we can watch the ebb and flow of what people are doing. And I've got to tell you, for the last 6 years or so, everyone wants to know about the stock market. Everyone wants to invest in the stock market. It's hard to really sit down with them. Not hard, but it's not what they want to do, and show them the diversity and show them the income that they have to take care of. Get that hard assets that we always talk about, our philosophy. Make sure your hard assets are taken care of, and it enhances your other portfolio. But we see it from the influx of calls. Everyone wants to be in the market right now.
Pretty much stock market real estate. That's it.
Right. Real estate too. That's
Dallas real estate. Either one of those,
look at it.
You're pretty good. Now, with the stock market stuff, it's difficult to get people to move anything right now because it's doing well. Market's made about 10% so far this year.
Now, on that note,
we're not bad.
We're not losing any stock accounts, are we, right now?
No.
Everyone's real happy. Hey.
My 401k's gone up good. My stocks have gone up.
Absolutely.
So they always ask me, what do you think about index mutual funds? I love them. I own them. There's nothing wrong with index mutual funds. Somebody's telling you that there's something wrong with index mutual funds is a bias. They're giving you a bias. Or just trying to sell you something else.
Right.
Anybody tells you annuities are the devil's work, they're just trying to sell you something else. They're just biased. Now, all things have benefits, but all things have negatives. Now, my opinion, some things like variable annuities, the fees are too high to give for that benefit that they're giving. You're paying too much for that particular benefit. That doesn't mean they don't have benefits. They do. Other types of annuities, I think, you'll pay a lot less for a similar or better benefit. And that's all it is. You got to ask yourself, everything's you put on a scale. All right, what does it cost? What is it giving me? What does it cost? What is the potential return? Now, what's the risk? Can I lose all this money? Am I willing to take a flyer on 10% of my money knowing that I could possibly lose it? Well, that depends on you and your personality. I am not. Don't get me wrong, with my stock piece, my growth piece of my funds, I do have a lot in there, but since I've been doing this 30 years, the market starts tanking, trust me, I'll pull out. I have no problem getting it. I'm not buying hold of the market's gone up 8.5 years in a row.
And what we're trying to share with you, if anyone categorically tells you not to do something, think about it. Whether you're talking about furniture or whether you're talking about buying a car or whether you're talking about investments, there's good ones and there's bad ones. There's a purpose, there's a reason for them, and you just have to go through and find the best ones that do what you want to do.
And that's what we talk about. That's why I called this the Common Sense Investing Show. There were actually some cooler names decades ago, but I kept thinking about it. For the show.
Oh, okay.
Common sense, if you really break everything down to its common sense component, does it make sense that somebody's, we talked about it a little bit last week, but that was just briefly. Does it make sense that somebody's paying 10, 15% on something when they can go to the bank and get 3%? Well, it does if you understand what their finances are. They might not have enough skin in the game. There are all kinds of different issues. They'd rather have investors pay for everything the cost of carry and everything, and they just get a smaller interest. But because of that, not having enough of a financial interest in it, a lot of times the banks won't loan them the money.
And like anything, as long as times are good, whether it's real estate or stocks, everything works fine, right? If you're withdrawing 8% and you're making 10, it works well.
I remember just a few years ago when oil prices kept going up and up, and I've got a lot of clients that own oil companies.
Correct.
And they were making a fortune. And they didn't come under the delusion that other people did. Other people were telling me, you don't understand. The Chinese and the Indians, they're using up all the natural resources in the world, and they're still having kids like crazy. It's going to be, this is the future. Then it collapsed. I have people that, like I said, that own oil companies that were hedged and ready for that the whole time. They go, I've been around a long time. Nobody's going to ever tell me that it's going to stay $100 a barrel. And they're prepared for that. Stay with us, folks. We've got a break coming up. Remember, if you have any financial questions or you'd like to take advantage of our no-cost, no-obligation retirement plan, Social Security optimization stress test, call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Well, you got to come see us at our new location. We just moved here, about a month ago now.
It's gone by fast already.
We're at the Star in Frisco, the home of the Dallas Cowboys, in the same building. Somebody was asking me, are you in the same building or just in the area? No, we're in the exact same building. Our address is 1 Cowboys Way.
Gotta like that.
There's actually 2 Cowboys Way, 3, 4, 5, I think. But we're 1 Cowboys Way, and they're actually building some more. But it's slowed down a little bit with minicamp breaking here last week. There's not as many people milling around. But
which makes it easier for you to park. I'm just saying.
The Frisco graduations always happen here. So I tried to come to work on a weekend during that. Oh, my gosh.
Just jammed.
Oh, I mean, they were parked way out. And I was like, well, I work here. They don't care. We rent this to the city of Frisco for that. So you're not a tenant today. I was like, never mind.
But it's fun, and you guys are welcome. We'd love to have you.
Yeah, all the Super Bowl trophies, the actual Super Bowl trophies are in the lobby. The Super Bowl rings, all the 5 rings are in there.
Yeah.
All the names of the elite Cowboys are on the ground. You'll see pictures of them everywhere. It's really neat. You can go to the Cowboys Club, which is their exclusive club, only 800 members, that has all the Sports Illustrated covers.
It's amazing. You'd be surprised how many covers they've made.
Oh, yeah. It's really, really interesting. Now, of course, I am a Dallas Cowboy homer. I'm from Dallas. I grew up in Preston Hollow. And Cowboys were everything. On the Sunday afternoons, we'd go to my grandmother's house, and we'd watch the Cowboys. And my kids ask me now, well, what kind of flat screen did you have then? No, there's no flat screen.
Well, yeah, not only that, I was going to say Preston Hollow wasn't Preston Hollow then either.
No.
I mean, it was, but it wasn't.
2,000 square foot ranch houses. Yeah, they happen to be on a half an acre.
Yeah.
So now these are mansions filling up all these acreages, right?
They've torn them down.
But it's beautiful. It's still pretty over there. I drove through there not long ago. It's still really pretty. Those trees were mature when I was a kid. Now they're just.
Where George Bush lives, doesn't he?
Somewhere around there.
Probably has your old property.
Yeah. Yeah, those were actually blue-collar neighborhoods back in the 70s.
Yeah, absolutely.
It's a different world now.
That's why you don't make money in real estate. You didn't hold on to that property.
Oh, get this. We sold it for, I think, $30,000 in the 70s.
The dirt $1 million now?
No, the dirt's close. It's nasty now. Like I said, they built Dallas, and people were going north, and my dad was like, oh, they're putting roads and highways in the middle of nowhere. Nobody will ever live out that far. Because remember, Northwest Highway was considered North Dallas, not LBJ and beyond. Now you're going at 121 and beyond, 380 and beyond.
380 now.
Oh, it's nuts. My beautiful Prosper, which was very almost like the country, but you're only 5 minutes from anything, right? And it's starting to get like Frisco now.
Yeah, it'll be built
people
out.
everywhere.
It'll be built out.
Oh, no. All right, today, let's talk about the bucket strategy. You may have heard this from other strategies that are similar. We have a little different spin on it, but the key to managing your money is not necessarily always the investments you put in it. A lot of times it's how you allocate those funds. Are you making the most efficient use of any of your funds? Because what you'll find is somebody's got the wrong component in their income bucket, and they're really stifling their income. They've got a better component for income in their cash bucket.
And a visual way to put that is if you're trying to get a round peg in a square hole, or a square peg in a round hole, it doesn't work. Where if you have a round peg in a round hole, it works real well.
Yeah, you've got to have these components. How many people come to us over the years that saved every penny in, say, an IRA or 401k and have zero outside of it?
Quite a few.
A lot more than you might think.
Quite a few.
Sometimes it's because just the automatic they were taking it out and they didn't know it was in there, because any cash gets in their hands is going to get spent because life happens. Kids go to college, whatever. I needed a new car. I wanted a new couch, whatever. But that happens all the time. So the number one thing you need in your bucket strategy, the number one bucket you need, are cash reserves. Cash, I have 4 children ranging from 31 down to 8. There's always something comes up. There's always something you need money for. We're in summer. Now I've got all the summer camps. Every one of the kids has to have 3 to 4 sports camps, or I'm a bad parent if I don't give them these sports camp. Then you got regular summer camp.
Yeah, well, not to get nostalgic or anything, but we didn't have that, and we didn't have mathnasiums and all these.
My parents didn't even watch me play football or baseball. Well, I might be to one game this year. Nowadays, the parents are there for all the practices and everything, and boy,
they take them from one camp to the next.
Well, now the kids play year-round, the same sport year-round. They've got special coaches, all this kind of stuff. So, but the cash reserves are the most important part of your bucket. Now, what do you put in cash reserves? Cash. Money markets can go in there.
And it's an expensive part of your portfolio. Why? Because it doesn't make anything. You still have to have it.
You know it's not going to make it because that's not the purpose of it. But cash, or you can have short-term CDs or really short-term bonds if they're kind of government bonds, really safe kind of bonds. You don't want to have long-term high-yield bonds in a cash account period.
You can even have fixed annuities, the 3-year and the 5-year type.
They got to be shorter term.
Yeah, but you have more access to it than you do a CD.
That's right. Cash reserves are very important. Liquidity is one of the most important things you have to have throughout your life and into retirement. And so that is a very big one that we concentrate on. Just make sure you're not putting the wrong thing in that reserve pile. We got a break coming up, folks. Remember, don't hesitate to call us if you have any financial questions or you'd like to meet us here at the Star. Our number is 972-715-2424, or you can go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by 2 of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Hey,
welcome back.
Welcome back. Before you get started, Victor, I just thought of something funny as the intro music was coming on. Dun 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 dun. I was visiting my mom last Friday, and she goes, I don't care for your all's music. But then I heard the music for the show after you, and yours is okay. So whatever that means.
I know what the other one was. It's like 40s music. I'm not going to mention who it is.
No, don't mention it. But yeah, she goes, I didn't care for your music until I heard the one after you. Yours isn't bad.
See, if you're like in your 50s and 60s, that's what you grew up with,
Oh, sure.
Now I listen to more Texas country than anything else, but I still like rock and roll. I just always have. All right, we're talking about bucket strategy and how do you allocate a portfolio properly to get the most efficient income out of it if you've got an income bucket, the best reserves, the best growth. So remember, cash reserves are king. Liquidity is king. You got to have enough liquid money when you're retired for sure.
And if I could interject, I know you're beelining here. What we do, when people ask me what I do, I think more and more, instead of a wealth manager or an investment advisor, what we do is help clients organize their portfolio, like what we're going through right now, to make it effective and efficient. And I can't tell you how many times people come in, and either they don't have enough and we can organize it so that they have enough and then some in retirement, or we have very wealthy individuals come in that have don't even need the money. But once we can reorganize it, and like Victor's talking about, the reserves are there. The income stuff is producing income, not growth. The growth stuff is producing growth, not income. Not only do they have what they were going to have left over, but sometimes that number can triple or quadruple because of what Victor's talking about, because it's doing the right thing.
Making it more efficient. And so you don't put stocks in reserve accounts. That's not your liquid cash for emergencies. Stocks are not in reserve accounts or in reserve buckets.
And it's not for income.
And now you got to remember, you can have one account and have several buckets in that one account.
Absolutely.
I would just always do a spreadsheet. Said, okay, here's my growth money, because that way, if you allocate it correctly to that, your whole portfolio runs much more efficiently. You will end up with more money than everybody else at the end, and that's the whole point of all this stuff. I don't necessarily need to leave anything to my 4 kids, but if I have a lot of money when I die, it leaves me flexibility. I could do what I want if I have so much income, because I've maximized my income bucket. If I have so much income, I'll even get more income than I'm spending. That's called a high-class problem. All right? That means I'm going to put a little more in my growth bucket, maybe a little more in my reserve bucket or my wealth transfer bucket. But either way, when you have too much of anything, that's a high-class problem. That's a good thing. Okay? So reserves are number 1. Your income bucket would be the second most important. Why is the income bucket more important than the growth or wealth transfer bucket? Wealth transfer, I just don't want to be a burden on my kids. If they don't get any money from me, but I was able to do my finances correctly where I never was a burden on them, that's a goal for me. So that growth, there's certain things that are best for growth. Income, the best things to produce income are going to be stuff that produces steady, repeatable income. Not a dividend that can go away to zero. You can put them in your income bucket, but it's not the most ideal or the most efficient thing to put in your income bucket. Think this. If you have the S&P 500, the dividends on it about 1.8% or 1.6.
Right.
So that might not be the most efficient use. You got $1 million, you're making $16,000 a year in dividends. That might not be the most efficient use of that money for income. You can use bonds. Bonds normally are ideal for the income bucket, but not now. Right now, they're not really rewarding us for the risk we're taking in bonds, because what happens? Interest rates go up, bonds go down. They're not giving us enough, and I know that. But if they're giving me 5 or 6% for a AAA 10-year bond, I'd be willing to take that risk. Not at 2%.
One of the things that Victor and I see a lot, as far as it's almost the right thing, but not quite. We see people try to use the dividends most of the time to take care of their income needs. And while that can be good, sometimes it's not a guarantee. It's not always going to be that number for you.
You know how many people have told me, well, you don't realize how much AT&T pays in dividends?
How about ConocoPhillips?
I do realize. I've always realized. What was 5 or 6 years ago the highest dividend payers? I had people, they're double digits, all of them. They were oil companies.
Absolutely.
Those oil companies don't pay dividends anymore.
Or they're 1/10 of what they were.
That's right, 1/10.
Cut your income down to 1/10 and tell me how happy you're going to be.
That's not consistent, repeatable income. It's based on, remember, you can stop a dividend. It doesn't hurt your company. It may hurt you in the future trying to sell more dividend-paying instruments, whether they're preferred stock or dividend-paying common stock, whatever. But it doesn't kill your company. There's no promise to pay dividends. It just happens to be we're getting profit right now, so we want to pay dividends.
And it's a good place for company to recoup some cash if they need to.
That's right. So they don't have to pay. So that's not consistent, repeatable income is number 1 is what you need in that. We got a break coming up. Stay with us, folks. Remember, if you have any questions, don't hesitate to call us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back. Today we're talking about a bucket strategy. We put a different spin on it than some other advisors. And we're trying to tell you, a lot of people understand having an income bucket, having a wealth transfer bucket, having a growth bucket, but they don't really know what to put in those buckets. We see this so often that they're putting the wrong stuff. And if you'd like us to take a look at your portfolio, to give you a review, an honest review, and a mathematical review, not some sales pitch crap, Call us at 972-715-2424. Again, 972-715-2424. You can go to our website, ilovemyretirement.com. I'm not sure if it's this weekend, but they just finished a new video that you can see on the front page there. I'm not sure if it's on the website now, but they did just finish it. We saw it here last
It will
Thursday.
be soon. And I would add, just think about it. If we could sit down and just chat, we take a look at what you have, and we could increase how much money you're able to get in income by 20% or 40%. Or for some of you who need a lot of income that you don't think you can get it, what if we can get you there?
It's amazing what you can do by taking a percentage of income, allocating it to a pure income producer, how much it helps the entire portfolio, where you end up with more money every month coming in, your heirs end up with more money, and for your entire life, you can get more money by allocating a small percentage. It's amazing when you look at the math of it alone. And that's all we do.
I know we're going to get into it later, but there's some neat things. You've heard Victor and I talk about Roth IRAs and being appropriate for you making a transfer from a regular to a Roth if you're in a high tax bracket in retirement. Well, what if you had $1 million in your IRA and you could take that and put $1 million, and now that whole $1 million became a Roth because you paid your taxes out of cash? What would that do to you? How would that affect you? What's the long-term effect of that? There's some neat things that
everybody
you can do.
knows the short-term effect.
That's right.
I lost $400,000 in cash.
That's right.
But the long-term effect is amazing. The difference is amazing.
We'll get
you
into
saw
it.
the math of it over a lifetime. All right. We talked about the reserves. That should be cash, short-term fixed income instruments only. Your income bucket. You can put dividend-paying stocks, but it's not the most efficient thing. Better is bonds, CDs, fixed annuities. The best income producers are going to be like some kind of life payout annuity because they're paying you part of principal back as well. But if you pick the right ones, you can put so much less into one. Just one example is, let's say we were talking about that 2% on dividends. The average S&P is actually like 1.6 or 1.8. But you get $20,000 a year on $1 million. What if I could take that same million and get $80,000 a year, freeing up everything else that doesn't have to pay bills anymore, because this is going to pay my bills. This could pay all my taxes too and all that stuff. It increases the whole portfolio. There is nothing in the world, income-wise, that'll pay you more than an annuity. The one thing you got to be careful of, stay away from any high-fee anything. I don't care if it's an annuity. I don't care what it's called. A managed account. If it's got high fees, it only benefits one side of the table.
And all these things that Victor just went through depend on your age and what your needs are. If you need cash now, it's a different direction. If you've got 5 years or 10 years to set something aside and let it grow, well, then that's another direction. So it really depends custom on what you need, what your age is, what your situation is.
What people usually do, the typical person has one bucket.
That's
Everything's in this bucket.
Yeah.
They've got a hodgepodge of 1 million different stocks, bonds.
And they're trying to get enough money in that one bucket.
All they're concentrating on is growth, not the efficient use of particular pieces of that money.
Absolutely.
And that's what we're trying to show you is, because I'm telling you, when you see an efficient portfolio and different than just a jumbled portfolio, mathematically, it jumps off the table. It jumps off the page. But you got to see it. That's why I always tell people, there's no cost, no obligation for any of those kind of services to show you if you're going to run out of money. If we can make it more efficient by allocating it correctly, call us at 972-715-2424 or go to ilovemyretirement.com. All right, now let's go to the next kind of bucket, the growth bucket. What's the best one? You can answer this right away. What's the best one?
How about stocks?
Stocks. Your growth bucket should be, there's only one investment vehicle, long-term, short-term, who knows, that beats inflation consistently. That would be the stock market. Then again, when you're doing stock market, stay away from anything with high fees. Your annuity, your income annuity, I see this a lot. They're putting an annuity into the growth.
Yeah.
All right? No, you don't understand.
Oh, yeah, these do.
I'm guaranteed this amount, or I'm going to get this much growth. that should be in the income bucket.
But we talked about this with annuities and everything else. There's some terrible stocks out there. There's penny stocks, Intermountain stock. There's things you got to stay away from. There's some really good stuff, and that's what you want.
Right. And I like index funds. It's my thing, or ETFs, because if I'm managing them myself, my fees are virtually nil, right? Very low. Even if I hire a manager that's using ETFs or index funds, even with their fees or whatever, I'm still paying a reasonable amount. It's when you start getting into some of these things, like these hedge funds. Remember in the 90s, hedge funds? Oh, my God, the hedge fund managers were owning Wall Street. Billions of dollars were their quarterly bonuses and things, right? It's craziness. But hedge funds they used to charge about 2% a year, plus 20, 30% of the profits. That's how they got rich. Yeah, it's just ridiculous, okay? And they even charge for trading costs in a lot of them. Well, you can get the whole shebang in an index fund for 0.1%, 0.06%, that kind of stuff. I understand it's not actively managed, but there's a point. You can't pay too many fees in a stock account or an annuity and have it work out for you, period. Stocks are probably the best growth vehicle out there. You can do other stuff. Some of your dividend-paying stuff, if it's paying a lot, that could be in the growth thing too. Think about, let's say you like gold. You can put that in your growth bucket, You could put, I've got people doing, how many emails I get about cryptocurrency? Uh-oh. I don't trust anything. It's just on the internet. I'm just sorry. Well, we got a break coming up. Don't hesitate to call us if you have any financial questions, 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome. Remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. Today we're talking about the allocation of your assets. The easiest way to keep it in my mind is a bucket strategy. You can call it anything you want. Asset allocation strategy. We talked about reserves. Reserves should be cash or short-term fixed income equivalents. In other words, something you can get hold of right now without a significant penalty to get hold of it, right?
Not going to make you much, but you have to have it.
That's right. Those are the most important. Your income bucket's the next. Now, how much do you need in your income bucket?
How much income do you need?
How much income? Some people want, all right, my income, I want guaranteed at least my hard expenses. In other words, expenses, I need $5,000 a month. That covers my expenses. That covers my lifestyle. Other people would say, well, I'd really like $10,000 a month because I'd like a little extra. So whatever it is, a minimum in your income bucket would be to produce your hard expenses.
Now, I would add, these buckets kind of commingle. You don't want to get too much in the growth. The income, I've seen instances where people need a lot of income and they'll put more into the income, sacrificing the growth. But I would add this, you don't want to sacrifice the reserves. You have to have emergency money. You have to have the reserves you can't sacrifice. Sometimes you can sacrifice growth if you need the income.
Think about it. We're doing this in order. Reserves, your income bucket, then your growth bucket, then your wealth transfer bucket. We're doing this on purpose because if you have your income bucket allocated properly, you can still eat. If you had everything in growth and the stock market went down for 10 years in a row, you can't feed yourself. You can't pay the bills. The income bucket is the most important thing. Yep. Do I have more coming in that is going out? Because some people will say, well, I have actually lived a little higher lifestyle, but I could tone it back. You can only tone back so much. Plus, you add inflation in there, so even your hard expenses are going to go up over time. So you have to have that accounted for in your plan. My hard expenses, even if you're going to go the minimum in the income bucket, make sure that it covers inflation as well. Because your bills might be $5,000 now. If you just have 3% inflation, they're going to be $9,000 in 20 years or whatever. Okay? The growth bucket is your next important item or bucket. And that stocks is the best thing for growth. You could put a lot of different kind of stocks. Don't go crazy with it. I think large cap U.S. companies should be the biggest piece of those stocks of that growth bucket because they're more stable and they're large U.S. companies.
Certainly, as you get older, right?
Yeah, very few of them go under. Small cap stocks have outperformed large cap, mid cap for a long time, but they also have huge fluctuations. And if you pick the wrong one, you could just lose all the money in that particular one. And so I like on my growth bucket, at least probably half of it in U.S. large caps. Then I start breaking down percentages into international. Now, I'm not buying banks in Paraguay. I don't like emerging market stuff. Maybe 1% if you got to go there.
And that stuff's kind of tightened up the last few years, too.
I'd rather like investing in Toyota, Mercedes-Benz, foreign companies that are big. I agree with that wholeheartedly. But it's still, my biggest is going to be U.S. large companies. Next is going to be, probably foreign large companies. Then you're going to have mid-cap and small cap. And what that does is balances you across several asset classes. I always have some kind of S&P 500 component because the S&P 500 is 80% of the valuation of the U.S. stock market, covering all 10 sectors of the U.S. market. So that gives you even diversification among a large cap. And you can get them for pretty cheap with all the index funds and ETFs out there. And so your growth bucket has those things, and you allocate within that. The last bucket, and the last bucket of importance, is your wealth transfer bucket. I'm not saying that leaving money to your heirs you shouldn't consider it. I've been doing this 30 years. It's more important to some people, less important to others.
It's more important for me to eat.
Like I said, I just don't want to be a burden on my children. But
exactly,
what's the best kind of thing to leave in a wealth transfer bucket? Well, stocks are really good, individual stocks. Why are individual stocks good? Because you have a stepped-up basis.
Absolutely.
You could have bought ExxonMobil at $10, and you die and it's $100. Your kids don't pay $1 on that $90 increase you had. So stocks are really good.
And they're good. Well,
what's another good thing to put in the wealth transfer bucket? Well, life insurance. Life insurance is tax-free. Tax-free, if you leave an IRA to your kids, well, they're going to pay, because 99% of all inheritances are spent within 18 months, believe it or not. And so they're going to have a pretty big tax bill if you close out an IRA. If you leave $1 million IRA to somebody and they cash it out, they're going to pay 40% tax on it.
That's right.
That's just the way it is. If you're having a state issue and you got worth over $11.5 million or whatever, then they might pay another 30-40% on it for a state tax. Okay, state tax is 35, whatever. But those kind of things get really nasty really quick, and so those aren't the most efficient way to leave money. What we concentrate here, what's the most efficient, effective way for reserves, for income, for growth, for wealth transfer?
Absolutely.
And so I don't want to leave. I'd rather deplete an IRA with income, because they're going to get part of that anyway. Required minimum distributions from the government are going to make me spend down that IRA anyway. I'd rather leave them other money. So use that for income, leave them the tax-efficient money.
Absolutely.
All right. Well, I appreciate everyone listening today. Oh, so does Guy. We appreciate you listening today. Remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. Go to ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.